Hi, we're back with part two of elasticity. We ended up a little bit earlier looking at own price elasticity and talking about how agricultural goods are generally inelastic. So the book gives you some examples of elasticities. And so every commodity has an elasticity. And basically it tells you that just keep in mind if you raise the price of beef by 1%, then demand will go down by 0.6%. So 0.6, 1%, 0.6. If you raise the demand, if you raise the price by 10%, then demand would go down by 6%. So it's just a percentage. And it's negative because demand decreases. So all of them basically are elasticity coefficients. There's only one elasticity coefficient here that would be considered to be elastic, and that would be this one right here. And so it says, so which product is most sensitive to changes in price? And that would be beer. Because if you raise the price by 1%, demand decreases by 2.2%. So it's very elastic. On the other hand, the one that would be the least sensitive to the change in price would be, you guess, cheese. So in other words, if you raise the price of cheese by 1%, demand's only going to go down by 0.3%. So cheese would be considered to be inelastic. That coefficient is less than 1. So anyway, maybe that gives you an idea of elasticity. Okay, and so then the book likes to use 10% instead of 1%. So this is an example of rice, which has known price elasticity of 0.1467. And so basically if you raise this one says if the price of rice drops by 10%, the quantity of rice demanded will only increase by 0.1467%. So 10% drop in price leads to a very small increase in demand, and you can look at the slope of that demand curve and you can see by the elasticity coefficient, this one, as well as by the demand curve that rice would be highly inelastic. In other words, you buy all the rice that you want, it doesn't have the price doesn't have a big impact on it. Okay, I'm going to skip over this, but this is a problem. It's a homework problem, and it has to do with changing prices and how much demand changes. But you can come back and look it over later because it is a problem in your homework. So you're going to probably want to come back and take a look at that. So I will just zip through that. Okay, another factor we're going to look at real quick is this idea of income elasticity. So income elasticity has to do with the second factor affecting demand, and that is a change in income. So if you get more money, your demand changes, you buy more stuff. So when consumers' income changes, their demand for goods change. So you might remember from chapter 3, two different types of goods. You can have normal goods or inferior goods. When your income goes up and you buy more of a good, that's a normal good, positive relationship. Inferior goods are goods for when your income increases, you buy less of those goods. So income elasticity looks at how much demand changes as your income changes. Okay, so we're not talking about elastic and inelastic anymore. We're talking about normal and inferior, a different concept. So again, we have a nice handy little formula to use for income elasticity. If they give you the percentage change, then you can do a handy, easy formula right here, just a little division problem. However, if they actually give you the quantities or the income change, then you would have to use this formula right here. So income elasticity would have to do with your change in income and how that affects the change in quantity demanded of a good. So the goods are defined here. So A is your beginning income, B would be your new income, IA, IB, and then quantity A is your quantity before the income increases, so that goes with IA, and quantity B will be the new quantity you buy when you have new income. So if you do that, you'll get an elasticity coefficient, and that will be your income elasticity coefficient. And if that number is greater than 1, the good is a luxury good and a normal good. If that calculation right here, or this one, lends a number that is less than 1 but greater than 0, so like 0.75, the good would be considered to be a necessity and a normal good. Okay, so we're not dealing with positives and negatives in this case. Actually, these two numbers should both be positive. If the number is less than 0, meaning a negative number, so like negative 0.25, it's an inferior good, right? That makes sense, because if your income goes up and you buy more of a good, that's a positive slope. It's a positive and a positive. Income goes up and you buy a little bit more of a good, that's still a positive relationship. However, if your income goes up and you buy less of a good, that's a negative slope. Okay, so here's an example, another example that is presented to you in your homework. And so basically this one, they're giving you a disposable income increase of 5%, and they're calculating elasticity for you. So you have to figure out how much demand is going to change. And then you're going to determine whether chicken is a normal good or an inferior good. And you can do that just by looking at this number right here. But they will do the problem for you. So, and I'm just going to skip through that because you can come back and look at those answers. Okay, finally, the last type of elasticity is called cross-price elasticity. And this one is probably the most confusing, but it's also the most intuitive. You really have to think about it. So cross-price elasticity measures how a change in the price of one good affects the demand for a different good. And we kind of already talked a little bit about this. So when we talk about cross-price elasticity, goods can be substitutes or complements. So if we talk about own price elasticity, you have elastic and inelastic. Income elasticity, you have normal, you have luxury, normal, and inferior goods. And cross-price elasticity, you have substitutes and complements. So you really have to get the terms down there. So in cross-price elasticity, goods can be substitutes. And so that's just common sense. When the price of one good increases and the demand for a different good also increases. So think about the price of beef increases, the demand for chicken increases. That means that the price of beef increases, you buy less beef and you buy more chicken. So we're not measuring how much demand for beef decreases. We're looking at how much the demand for chicken increases. So the goods are substitutes if they show a positive relationship. So a positive elasticity coefficient, beef prices go up, the demand for chicken increases, those are substitutes. Complements are things that are consumed together. Things that are consumed together. So when the price of one good goes up, the demand for a different good decreases. The example tells it all. So the example basically says, and I know my face is probably covering up some of it, if the price of peanut butter increases, the demand for jelly decreases. These goods are complements. They're consumed together. So a price increase in peanut butter causes a demand decrease in jelly. So I think the homework assignment is to look at some examples of substitutes and complements. So we're going to give you a big ugly formula for that. And basically, again, the numerator is the percentage change in quantity of one good and the percentage divided by the percentage change in price of a different good. Okay, so the thing about substitutes and complements is you create that shift in demand. So think about it. If the price of peanut butter increases, that would be a change in price on a demand curve. However, if peanut butter and jelly are complements, then the demand for jelly is going to decrease, and that's going to be a shifting demand curve to the left, like we learned about last week. So, already told you this, if the cross price elasticity is a positive number, the goods are substitutes. Price of beef goes up, the demand for chicken goes up. Beef and chicken are substitutes. It's a good thing to know, especially if you're in the chicken business, right? You know, you got to produce more chicken if the price of beef goes up. If the goods are negative, when the price of peanut butter goes up, the demand for jelly decreases, those goods are considered complements. And then some goods have a zero relationship when you do the calculation. And a zero would be that they're independent. Like if the price of oranges goes up, how does that have any impact on the demand for beef? No, probably not. So those goods would be independent goods. Okay, and then your book gives numerous examples of um, spaghetti sauce. So they say these are elasticity coefficients. So if these are elasticity coefficients, they're all greater than 1. If you take the absolute value, or if you just negate that negative sign, because negative means demand decreases. So which one is the most elastic? So they're all elastic. Which one is the most elastic? It's Hunt's. So Hunt's, that's just a characteristic of that particular product. Okay, so all these values are positive, 0.1, 1.03, 0.81, 39.14. Those are all positive numbers. Remember we said a positive number means that they're substitutes. So obviously Prego, Ragu, and Hunt's are all substitutes for each other. So you can figure out which one is the best substitute and which one is not as good of a substitute. So an increase in the price of Ragu spaghetti sauce has a larger impact on the demand for Hunt's rather than vice versa. I don't know if that's very practical. A 10% increase in the price of Ragu spaghetti sauce increases the demand for Hunt's spaghetti sauce by 5.3%. Whereas a 10% increase in the price of Hunt's spaghetti sauce increases demand for Ragu only by 1.4%. Okay, so this is another problem, a homework problem that's in your book, and it's worked out in the PowerPoint, so you're probably going to want to go back over it. So the cross price elasticity for hamburger demand with respect to the price of hamburger buns is equal to negative 0.60. So these goods are complements. Makes sense, right? Hamburgers and hamburger buns, those are complements. So basically they're asking you to calculate if the price of hamburger buns rises by 5%, what impact will that have on hamburger consumption? So how much will demand change for hamburgers? And what is the demand relationship between these products? That just means, remember, a negative for cross price elasticity means that they are complements. And that makes sense, right? And so there you can see how they did the calculation. So you can go ahead and use that to help you. I think the question might be the exact same one in your homework. Makes it a little bit easier. Okay, and then this is another one, very similar idea. So they're looking at Pepsi and Coke, and you might think just right off the top, Pepsi and Coke are not complements, but they would be substitutes, right? Some people, I know people who like Pepsi and they would never consider Coke to be a complement. But in general, they're both brown carbonated beverages. So they could be substitutes. And basically, if you raise the price of Coke by 5%, what impact will that have on Pepsi consumption? Well, common sense says that if you raise the price of Coke, and Coke and Pepsi are substitutes because they have a positive elasticity coefficient, positive, they're substitutes, then the demand for Pepsi would increase. So you can figure out how much it would increase by doing the problem. And there we go. Okay, and the last thing they talk about in the chapter is this idea of price flexibility, and it is the reciprocal of own price elasticity. So if the calculated elasticity is negative 0.25, which means that good would be highly inelastic, less than 1, highly inelastic, the reciprocal would be 4, right? This would be 1/4. The reciprocal would be 4/1. So that is the flexibility of demand, the price flexibility of demand. And so we said that I just put this in here because I thought it was a little bit practical. So it gives you an example. This is useful to producers when forming expectations for current year. So if the USDA projects an additional 2% supply will likely come on the market, then producers will know that price will likely drop by 8%. So that has to do with that idea of the reciprocal. So as as supply increases. Remember, we said agricultural goods in general are